I'm saying, and I may upset some people here.
Oh, I like this. This is juicy. Here's a soundbite.
But the goal of higher interest rates is to create job losses.
All right. Thanks for tuning into the Highest and Best Use Real Estate podcast, where we talk about techniques to optimize your land, structure, skill sets, and time, as well as highest and best use principles to make your business more profitable, productive, and efficient. I'm your host, Ryan Carr, reminding you that good deals are found, great deals are created. And today, the one and only Mr. Quentin D'Souza is on the show. Quentin, thanks for being here.
Oh, thank you.
I'm really excited about this. Quentin's a good friend of mine. He has a portfolio of hundreds and hundreds and hundreds of units. And he's also the Chief Education Officer at Durham REI. So I'm excited.
Thanks for having me, Ryan. I appreciate it.
Okay, topics for today. So you're a super smart guy. So now that you're here, really excited. Market highlights. So 3 things I want to cover. So market highlights and market economics. You're really good at pulling data, analyzing the data, and then taking action on that data. So I want to talk about maybe where we're at. If you could rub your crystal ball for us, tell me where we're headed, that would be great. Number 2, highest and best use of your time. So what does your business look like under the hood? Where do you spend your time? How many employees do you have? Like all this stuff. Tell us a little bit about the background, the behind the scenes, right? And then number 3, some of your own projects. What are you working on? How do you find highest and best use of those? Right. And I know you've got a bigger building somewhere with some vacant land behind it that you were talking about building on. Yeah. I'd love to hear a little bit more about that and drive down that path.
Yeah, absolutely. Happy to. Yeah.
Market economics. Let's start there. Where are we at?
Where are we at? We want to talk about interest rates because that's like the summer barbecue conversation.
For sure it is.
Of everybody.
They suck.
Yeah. Well, there is a cycle of everything, and real estate moves in cycles. Interest rates move in cycles too. They go up, they go down. And not often do they stay the same forever. Mm-hmm. So this is a situation where we're seeing that. I think people need to remember that there is a difference between interest rates and inflation rate. And if you think about it this way, interest rates are now, let's say, 4%. Okay.
Right.
What is the CPI?
You talking prime?
Yeah. Just say like around, let's say interest rates between 4 and 5%, somewhere around there. Okay. Yep. What's the CPI right now? 8%.
Yeah.
So if that means that money is losing 8% of its value, right? Because when you have inflation, you're increasing the money supply, but you're also increasing the cost of goods, right? But your dollars don't change that you had in your account. So what you have is still negative real rates. That means you're getting paid to borrow money.
Right.
Right.
What a time. Yeah. What a time.
So who wouldn't want to get paid to borrow money?
Yes.
Right. And that's the key that we have to remember. I think people get lost in the media hype of what's happening in the last, 30 minutes, 30 days, 3 months.
Yeah.
But they forget about the next 10 years. What is the next 10 years going to happen? And what does that look like? And what has the last 10 years look like?
Sure.
Right? If you bought a property in, let's say, Oshawa 10 years ago, it was a detached home.
I'm getting pretty close to that now.
Yeah.
It's true.
but what would that property have cost?
Yeah, way less.
Like maybe, I remember we were buying like detached houses and putting suites in it for $300K.
Yeah.
Right. And the cost of the suite was like $50K.
Yeah.
Right. So we're into it for $350. That same
$50K for a suite.
Yeah.
Oh man.
Yeah. We were doing it. Absolutely. We're doing it every day.
Everything was way less then.
Everything was way less.
Yeah.
And just the efficiencies of doing many of them at a time. Right.
Sure.
But you think about that. We were at $350 10 years ago. And for that finished product, today, that finished product is worth, let's say $900. Right. So don't get lost in the fact that, what's happening about interest rates. Interest rate is a cost. Right. Okay. Property taxes is a cost. Insurance is a cost. But remember, what are you investing in? You're investing in an asset in real estate. That asset has a number of different ways that you can profit. One is holding on to that asset over time and appreciation. In this market, in Southern Ontario, over time, that is what will make you the most money. You will become wealthy from that.
Do you think it's the demand side of it that's causing the appreciation?
It is, and it always will be. because we have governments that can't agree with each other.
Oh my gosh, building permits are so slow.
Yeah. I mean, we just talked about this before.
Yeah.
What happens when the federal government says we want more houses?
Yeah.
Okay. And then the provincial government says, yes, we want more rental units and more houses. And then the municipal government goes,
No,
hang
on.
You know, the NIMBYs come out and the bananas come out.
Yeah,
it doesn't matter what
the
you
bananas.
suggest.
Yeah.
Right. Build anything nowhere and nothing anywhere.
That's
people,
right. That's right.
They don't care what you want. They're not going to want you to build it.
Yeah.
And this is what's happening today and what has been happening in Ontario for decades. Okay. So yes, we do have that shortage, but like that appreciation piece is one. The other one is mortgage pay down is another. Okay. Interest rate is a cost. Just remember to fix it and make sure that you're buying something that is cash flow positive over time.
Right.
And if you're concerned about interest rates, go use the 10-year rate in your calculations, right? For your cash flow numbers.
Yeah.
And just make sure you're cash flow positive with the 10-year rate.
What would that be now?
I think it's closer to, no, it's not that, it's not as high as you think. It's like 5.25, something like that for a 10-year rate.
Because 10 years ago, rates were what, 3?
Yeah.
3.5?
Yeah.
I remember the first house I ever bought. I was like, oh my God, rates are at an all-time low. Everyone's saying all-time low. So I locked into a 10-year at 3.25%, 3.5%. And then I broke that mortgage a couple of years later to refinance and I got smashed on the penalty. Oh my God, that was a bad decision. But how do we know, right?
No, but I think the thing is too, if you still cash flow at 3%, you're ahead. Yeah. Right. What you're doing is you're probably trying to unlock some equity.
It was.
Right.
At the time,
or you're trying to increase your cash flow, one of the two. Right.
Yep.
So you're trying to make your portfolio more efficient, which is fine. But if you think about what we're doing here, we can use appreciation, we can use cash flow, we can use mortgage pay down, we have tax efficiencies, right? Because what often happens when people in businesses make money in their business, they have to pay taxes on it.
Right.
You have appreciation locked inside a building. You're not paying tax on that, not until you sell the asset.
It's like an equity gain on a business. It goes tax-free.
It goes tax-free.
Right. Yeah.
And then the other one is highest and best use, right? That you're using sweat equity or you're using your brains and you're being able to take that asset and increase its value. And those are, the benefits of it. So stop thinking of interest rate, all you people out there, stop thinking about interest rate as if it's like the world ending, for real estate. Sure, it affects residential real estate. 1 to 4 units is really being affected right now.
Yeah.
In the grand scheme of things, if you look at it from a 10-year perspective, it's just a cost. Just get used to it. Make sure you're buying something that makes sense and has a long-term gain, and you'll be fine. Yeah. In commercial right now, we're not seeing any changes in cap rates.
Really?
Yeah. Not
interesting.
Not very, like there's just so much competition for the same buildings and people aren't building those buildings. So,
they take a long time to put up.
And look at the municipalities, the NIMBYs.
Yeah.
Right. They are like the wall that is stopping a lot of construction from happening.
Yeah.
Right. And I don't see it changing I really don't see.
I'm really surprised it's not compressing cap rates, or releasing or whatever, like changing them at all.
Yeah. So increasing cap
increasing cap rates. Yeah.
Right. So a cap rate is, when you look at a cap rate, you have to divide it into 3 parts. So the 3 parts of a cap rate, one is interest rates. The other is the quality of the asset, right? Like the condition of the building. And the third is the location of that building. Those are the 3 parts that make up a cap rate.
Interesting.
What's happening is part 1 and part 2 are compensating for part 3 right now because there's just not as much product. Okay. Now, depending on the size and what you're competing against and who you're competing against, right? If you're looking at like 6 to 12 units, everybody can be in that market. As you get from 12 to 20 units, there's a lot less people that are competing in that market. You get from 20 to 100 units, you're competing with even less people in that market.
Are you against the REITs at that point, or is that too small for a REIT but too expensive for the mom and pop?
It depends. So last year we were taking down 202 units. That would be a REIT type of competition. In sometimes I have bid on buildings where I've lost out to different LPs that are like well known.
Yeah.
I don't want to give them any extra publicity, but like they're well known across Canada, and they have a lot of funds that they've raised, so they're able to buy things at a lower price, at a higher price without any debt or low debt, right?
Interesting. Why? Okay, hang on. Why is that? Do you think that they're forced? And this is a question I was going to ask you later. But do you think that somebody like an LP or a REIT is forced to use that capital because it's just sitting there idle, even if they have to take a lower return to deploy it?
Well, it depends on how they've organized their REIT structure, because what they could do is, you remember when you're looking at a REIT, they're appealing to a more general audience. And I'm looking at this as well for myself.
To become a REIT?
Yes, to do a real estate trust.
Yep.
Right? Because who you're appealing to is the mass market. You're not appealing to real estate investors or people who are interested in private equity.
Right.
Those people are used to returns in the stock market between like 4 and 8%. Right. They're not used to the 20 and 30% or more that we see in real estate. Right. So you're appealing to a different segment.
Meaning they have lower expectations.
Right? The other thing is they want more security, and a lower loan to value gives them more security. So if you say I have 50 or 60% loan to value, although it affects your ROI, your annual return, your IRRs, right? You end up giving them more security because they feel like they have less, debt in them. And so that's one way of positioning it, and how a REIT can do that.
Yeah.
So it just depends on, what you want to do and how you're presenting it to your mass audience, because the returns are lower, right?
Right.
And
the effort's also less too. If you're an active investor, you need to have that expectation of a higher return to justify your time, right? Whereas if you're a passive investor, maybe you're okay with taking a bit less money because you're hands off. Would that be fair?
Yeah. And also REITs profit differently. So REITs profit by assets under management, right? So they get a asset management fee. Let's say maybe it's 2%. On the assets that they have under management, right? And what equity they've been able to raise in order to do that.
Whether it makes money or loses money, they get there too.
They're a fund manager.
That's it. It's a service.
It's a service, right? They may own a bit of equity in it. Maybe there's a waterfall if the value has increased above a certain percentage, and they get a higher amount of equity from that. But it's a very different model than the private equity model that I've typically used in the past, right? We've got just over 120. If we're closing on another few buildings over the next, we should be at about like 125, 130 million in assets, right?
Yeah.
I'm an equity owner in those assets. The least I own is like 25% in an asset, 25% of that building. Most I own is 100%, right? And so, even when you look at our mortgage pay down, we get about $1 million in mortgage pay down annually on our portfolio. I get probably about like 600,000 of that.
So if you average like the aggregate of your portfolio, you'd be about a 60% owner of the whole thing.
I would say,
if you're 100 over here and 25 over here, and give or take.
Yeah, I would say about there. Yeah, about that overall.
Yeah.
So
it's a big portfolio.
Yeah, it's a big portfolio, but I continue to enjoy what I'm doing, and I still want to continue to grow. And I think that what got me to this point has been great. I've really enjoyed it. I've enjoyed working with the partners that I have and the projects that we've done. But I think I need to change also from what I'm doing to get to. I'd like to get to 250 million in assets.
Yep.
And what got me here isn't going to get me there.
That's what they say.
So I've got to. That's why I'm looking at working with family offices. I'm looking at working with a fund model. Just doing things a little differently where I work with accredited investors. That's how I'm able to do the projects that I've done up to this point. But it's cumbersome for me. Like I'm going out like, hey, look, I've got a project coming up. I've got to raise $2 million. This is what we're doing. It's 20 units, blah, 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 blah. This is the IRR full package for the accredited investor.
Yeah.
And, you go out to your groups and,
Durham REI, sign up. If you're not members, sign up, folks.
Well, yeah, that's been, they've been great people in that group for sure. But it's the connections that you make over in different areas, right?
Yeah.
like usually, you can find that in that type of group. And I'm always looking at different places to find accredited investors, but golf courses, right? Golf clubs.
Yeah.
You're probably looking at business events,
Yep.
entrepreneur events. Those are the type of things where you meet that type of accredited investor.
For sure.
Right. Whereas in Durham REI, it's a lot of other people learning to do it themselves.
That's true.
Yeah.
That's true. Different levels.
Different levels. Yeah. So,
I love when we go to the meetings, like you say, like who's got 1 to 4 properties or 5 to 10 properties or 20 plus property, whatever bracket you're in, there's somebody for everybody in that group, which is cool.
Yeah. And the 20 plus people can talk to each other right, and help each other.
Yeah.
Right?
And then fund level is like a whole other thing that doesn't even go up on the board. Yeah.
That'll be interesting.
Yeah.
Yeah, and I think we want to make sure to help each other for sure.
Sure.
But the economics of what's happening, the economy. One thing I think that people don't talk enough about, and I mentioned this in an email this morning, is we have increased our money supply to an extent that is like let's say we had $1 trillion 2 years ago in our total money supply, money that's ever been created in existence in Canada.
Canadian side. What do the US call it? The M2, M1, M2?
M1,
something?
yeah, they have M1 and M2 as well. But we have created like an additional, let's say 500 billion in money supply in
change.
2 years.
Jump change, yeah.
But that's huge. That's a huge jump. Now, all of a sudden, you have that much more money that's available.
Yeah.
We're competing against what? For scarce goods. What are scarce goods? Well, we can, you can make more money, but the goods that are out there are still only limited, right?
Supply and demand.
Supply and demand.
Yeah.
Right. And so you're competing over fewer, scarcer goods. And in this case, we look at energy, we look at wood, we look at, sometimes like copper elbows, like we're missing like copper piping or whatever it is. Right? We're paying more for those. There's more money available to go to those things, right? Because we've increased our money supply. We don't talk about that enough.
Yeah.
And I think that's something that's really important. The other piece is the wage price spiral that we could be getting into here, where we
up or down?
Up, because you've got inflation that's coming around, right? And you have different unions that are going out and saying, look, my cost of living has gone up 20%. I need a 20% raise. Yeah. Right. Yeah. So, which is fair. It makes sense, right? Stuff goes up. Yeah. So, but what ends up happening is their wages go up 20%, but then the cost of other things go up 20%. Everything. And so this is the spiral that keeps happening. So you got to be careful with that. And governments are aware of it, and and it's something that can really affect the cost and continue to cause inflation to happen. So here's a juxtaposition. So right now we have prices of everything, prices of life, call it, going up because of inflation, increased money supply, and so on, right? We also have interest rates going up, right? Which is pushing the price of real estate down. Why is that happening? Is it a short-term carrying cost problem, or what's happening? Yeah, I think that there's a lot of things that happen. When you push interest rates down, you pull forward purchases from the future into the present. Gotcha. Right? So let's say Benjamin Tall said that you're borrowing from the future and bringing it into today. Right. Yeah. Many economists say that that's exactly what lower interest rates do. You borrow from the future to bring it forward. Right. So what you've probably done is pulled forward a lot of purchases into the like the last 2 years that would have happened future. Yeah. Right. Yeah. And so what you've probably got now is a little bit of a lull that's happening, right? Because of not only are interest rates going up, but we still have terms that are in those interest rates that are affecting the purchasing power of people. Yep. Hence stress test. Yes. Right? Why do we still have a stress test? We've actually, now that we've protected ourselves, now we're at the point that was to be protected. Well, here we are. So here we are. And it's still difficult for people to qualify. Yeah. So why do we still have the stress test, right? So that's something that should be removed, right? Also, some of the, what ends up happening as well as with increased interest rates is we slow the lending of funds, right? And we are very much a credit-based economy. Would they call that the velocity of money? Partially, yeah. But I'm talking more around the just creation of more credit.
Right.
Okay.
Right.
So let's say if we are looking at lending, right? Would you say lending is harder or is it easier than 2 months from before or 3 months ago?
I think it progressively gets more difficult.
Right. And what I see is that credit growth slowing. And when credit growth slows, often we go into a recession. Right. When credit growth is growing, we're often in an expanding economy. So if what is going to be happening is we're putting pressure on interest rates, right? We're pulling forward. We've pulled forward demand from the future, right, to the past now, and we're getting less credit growth. We are going to be slowing down not just the housing market, which plays a significant role in Canadian GDP.
It's huge in the GDP. I forget the number. Maybe you know. I thought it was 25%.
Yeah, it's higher than, but it used to be something like 6%, and now it's somewhere between 10 and 20%. I can't remember. It's grown to
it was the realtors in the construction sector and all of the periphery services, mortgages, all that. It's huge.
Yeah, and it's all added to that, right? But we have this now. We have credit growth slowing, and we have higher interest rates. What is the goal of higher interest rates? I'm saying, and I may upset some people here.
Oh, I like this. This is juicy. Here's a soundbite.
But the goal of higher interest rates is to create job losses. Right. That's what it is. It's to push down on demand because government cannot create more oil. They cannot create more wheat. In fact, I don't even know why we have fertilizer laws that the Canadian federal government is putting in. Like, it just makes no sense. Like, disconnected from reality in this woke culture. I don't know. But I think that there's a lot of things that we need to have concerns about. But if they cannot create these items that we need, they're pushing down demand. If you're pushing down demand, that means that people are going to, not be employed in those sectors anymore. When you have people not employed in those sectors anymore, what ends up happening? Unemployment goes up. People are losing jobs. So there's a balance.
Which quails inflation because they have less disposable income to spend and so on.
Right. Yeah. And so they only have the lever on the demand side, right? They don't have the lever on the supply side. Look at housing in Ontario as an example. Do they really have the lever on like the federal and provincial versus municipal? No. You would have to eliminate control of zoning. Or no, you can give municipalities zoning. You just can't give them anything else.
That's right. That's right.
Right. So anyways, there's a lot to talk about, but there's, within the economy, I think just don't get sidetracked by interest rates. Interest rates are low and they're still low. Okay. Even at 4% or 5%, they're low. This is like an average interest rate. Okay. You just have, it's been a generation since people have seen it, but this is an average interest rate. So if your numbers don't work, then you need to make sure that the asset that you're buying has the cash flow that will be able to sustain
to support that.
For 3 years, right? 2-3 years out, right?
What do you think we're going to come back? Do you think it'll come back to a lower than what we're currently at?
Everybody keeps saying that, and when everybody says something, I usually think that maybe we're not going in that direction.
I don't know. I have no idea, right?
I've heard that so many times and I do believe that government will overcorrect and they'll go too hard with interest rates and they'll cause issues that will force them to retract some of those interest rates
because they snap them up pretty fast.
1% is too high too quickly, and probably because they didn't react quickly enough earlier. Right, and now they're trying to overcompensate, which government does because they're not really connected to reality in any way. But
inflation's a lagging indicator. Like what happened 3 months ago. And then the stats come out and they're like, oh, geez.
And then we know we're overcompensating, correct, right? We're at 8%. Well, what? We're at 8%.
Yeah. Oh, geez. Yeah,
well, if you look back at the third quarter, in the fourth quarter in 2021, interest rates were going up at 1%. or sorry, CPI. So CPI was going up at 1% per quarter. Okay, so then what happened? Nothing.
Yeah.
Right. So they actually didn't follow their own guidelines for what is an acceptable because they have a guidance for what is an acceptable inflation rate. And when it went beyond that, they really didn't do anything.
They didn't. They said transitory.
Right.
Yeah.
And transitory may be more permanent now because we're
permanentory.
Yeah, and I guess they thought that they could add all this money to the money supply as well, and it would do nothing. Is that what it is too? and they have so much debt on their books.
Right.
How do you deal with that much debt on your books? If you're a government,
you inflate the debt away.
So is it really do they really not want inflation? No, they want inflation.
Yeah.
Right. Do they want?
Well, that's
inflation?
the target. Even in a normal year, not up, not down, whatever, their target is 2% inflation.
Exactly.
Right. That's their benchmark.
Yeah.
So anybody that has an asset, or anybody, to your point, anybody that has inventory in their sporting goods store or whatever, if you don't buy it this year, next year it'll be quote unquote 2% more or more than that.
One good way to show this is go back to the house in Toronto in 1970 that was $15,000. Okay, I have lots of friends who's they had houses back then. I didn't. But they had their family had a house, and they bought it for like $15,000 or $20,000. That house today is probably in Toronto is like maybe let's say 1.5 million.
Yeah.
Fundamentally, the house hasn't changed. Actually, some houses they haven't even renovated them.
That's right. They're the same.
Right?
Yeah.
But the house is worth $1.5 million.
Is it the dirt or the structure that's appreciated?
Is it that's a good question. Yeah, that would be a good question to kind of think about. But fundamentally, the house hasn't changed.
Right.
What I want to say is that the value of the dollar has decreased.
Interesting.
Over that period of time.
Yeah.
And that the value of that dollar continues to decrease. So what we don't want to do is hold on to those dollars.
Right.
What we want to do is hold on to the assets.
Let them out into the world.
Yeah. Hold on to assets that continue to appreciate in value, or at least hold their value at the very least.
So would it be fair to say that you're short-term bearish, long-term bullish on the way that the market currently stands?
Yeah, I would say so.
Is that fair?
Especially, I would say short-term bullish in the 1 to 4 unit space.
Bullish or bearish?
Bearish in the 1 to 4 unit space. I would say the commercial space, I'm still bullish.
Just carry on. Yeah. Do you feel that because you have so many assets now, you're pot committed, you have to say that? Would that be a fair or unfair question?
No, because I wouldn't continue buying assets.
Okay.
Right. I would just hold on to the assets that we have, and then not continue to buy anything else.
Interesting.
Right.
Because you see some people, like governments do this too. They get up on the podium and they're like, oh, everything's amazing. The economy's great. Right? And then tomorrow, like the stock market nosedives. And you're like, what the heck just happened?
Because they have no clue. Let's be honest. Does any politician have a clue?
Going for votes.
Yeah.
Going for votes.
For 4 years, right? They don't even have the continuity of looking at the whole for a longer period of time, right? They're only interested in being elected for the next 4 years.
Yeah.
Sorry, I'm not a fan of
politics
or politics in general.
Well, when these guys or girls, like whoever's getting voted in, like when they go for their platform, if they're only thinking in a 4-year time horizon, and you're doing infrastructure projects, like that infrastructure has a shelf life for a really long time, but so does the debt that they spend, and so do the jobs that they create, right? So there's always that balance of like, what are we doing this for, and how long will I be remembered? Would that be fair? Yeah, for sure. And often they're pandering to the voters in their local area, right? And sometimes those aren't for example, a good example is they wanted to have landlord licensing all over Oshawa. Yeah. Right. And when you dug down to it, you find the counselors who are I was going back and forth and I presented, and one of the counselors at the very end was I was putting forth that the fact that you don't want basement apartments in an area is NIMBYism. That's what it is. Yeah. It's the definition of NIMBYism. Yeah. And the argument from the counselor was something along the lines of,
Well, it doesn't keep the original intent of the street, right?
Is that what they said?
Yeah, but it was the very last thing that she said in that last argument, and I was like, "Wow!" So this is really
so now I know where you stand, kind of thing. Yeah,
yeah, and it's not about landlord licensing; it's about keeping rental units out of your area.
Yeah,
that's what it's about.
Yeah,
right. And that's the problem with politics and politicians. We're not looking at the bigger picture of what the benefit is.
That would be a quail on supply in itself.
It would.
Right?
It would
add more cost, add more expense to create that rental unit or to maintain it. Means less people might be interested in doing that action.
Yeah. Why would they do it in Oshawa? Why not just go to another municipality that doesn't have that?
Yeah, and there's tons.
And there's tons. And they'll make more money.
Yeah.
Right?
Yeah.
So I think that dollars will always go where it's treated best, right? You're going to do your projects in areas where it's treated best. And just to go back to multi-units versus the residential and why I'm bullish, I think that, just like highest and best use of taking a piece of property and, let's say you buy a duplex and the highest and best use, or buy a detached house and the highest and best use is putting a duplex, like an additional dwelling unit in the basement. And now, garden suites are starting. So you go back to your original portfolio, and highest and best use is not just having the duplex now, it's adding a garden suite into that same lot. That's changed over time.
What are your thoughts on this?
I think it's great. It's great for adding density. I don't think it's quick enough for municipalities. I think it's a Band-Aid solution for something that they should have been. There should be a 30-unit condo on the building that we're standing on, but because of NIMBYism, we're not, right? And this is the problem that everybody has. All developers have everywhere in Ontario, right? And
density and zoning. Every time.
Yeah. And if zoning allows it, it should be you should be able to build it. That's end of story. There should not be anything that a municipality does to prevent it. Right. And this is not what's happening today. And in fact, like development charges, I don't know how anybody develops anything in Toronto. Because in the last year, they've gone up like something in 40%.
It's a lot.
Right. I don't know how you build it. I don't know why they think that they're special, but they obviously don't want anybody to build anything in Toronto.
Don't they re-review the DCs like every 4 years, every 6 years, 7 years? There's a time frame. Every so often they do it. And I think last time I read this article, they didn't raise the DCs in Toronto. So this time they hammered the developers with the DCs. It was something like that. So there was that window there where you're like, cool, I'm paying DCs from like years ago, right? And now they've brought it back through and you just get drilled.
Yeah, and you know what? It's just going to make it very hard for small and medium development to happen. I'm sure the big developers overall will be fine, but I think you're going to see a lot less of those small developments happen unless they've really bought the land at a like inexpensive cost. I think they're...
So here's the thing though. I'm always looking at, if you're going to build a building and you buy the land for a certain cost, and then you build the building for a certain cost, whatever let's just say you're going to build it to sell, right? What your net profit is on the back end of that construction project may, depending on how efficient you are with construction, may be the same net profit as if you developed the land and sold the dirt.
Right.
So at that point you say, okay, I made the money on the dirt, but why did I build the building?
Right.
Right. If the money was in the land and not in the structure, why go through that act?
Yeah, and that's very true. But then there's the problem, right? Like your profit is in the dirt.
Yeah.
There's no profit in building. Why build at all?
Why build it? That becomes a supply constraint.
Right.
Right.
And so this is
so they don't incentivize that.
No, or the cost of land will need to come down to compensate so that there's some profit on the back end to make these buildings worth building,
worth doing it. Yeah.
Right. And so there's some real challenges that are going to be happening, I think, in the next couple of years when it comes to development, for especially 1 to 4 units. I think, just that whole space altogether. I don't know if we have a number of units that come off the market. People aren't selling those units anymore. They don't want to sell. All of a sudden we could be back in a very similar situation, right? Because yes, it is a supply and demand. So if we have less people who've listed
Yeah.
And they start I think I heard something like 30% of properties are relisted properties on the,
I believe it.
right?
I do. There's a lot of didn't sell, take it down, relisted a week later at a different price.
Right.
List low, list high, try the strategy.
Try different strategies,
Yeah.
make it work, right?
Yeah.
So when we start to see them just pulled off altogether, right? And we have less overall supply in the market, and it is matching more of what demand is.
Yeah.
I see us getting back into a similar situation.